Welcome back to the video, guys. Today we're jumping straight in to show you what you can expect to earn by taking on different levels of risk with crypto DeFi liquidity provision. Let's dive straight into it without further ado and show you exactly what type of yields you can expect. Okay, so I want to start off this video by saying that everybody's risk appetite is going to be a little bit different. That's going to depend on a variety of factors. It might depend on how much income or how much disposable income you have to invest. It might depend on your life situation. It might depend on how old or how young you are, your investment time horizon. And so don't feel like you have to be pigeonholed into a certain type of risk profile just because of what other people are doing in the crypto and DeFi space. Of course, we tend to advise and bring people back towards being much more conservative with their allocations when they're working with us in the fast track program. You can check out the link in the description for that as well. But everyone's risk profile is different. And the whole idea here is to kind of explain to you in this video the different types of yield that you could expect when you actually take on different levels of risk. And so, again, nothing in this video is financial advice, guys. Always do your own research. I just want to give you an indication on what I've experienced myself and what we experience with our hundreds of clients in our fast track program. And so, what you're looking at here is a low to high volatility spreadsheet. This is a resource that we update on an ongoing basis for our fast track group. And we're always seeking out new opportunities, but that doesn't mean you always have to be chasing the next shiny object. Sometimes keeping it simple, keeping it low to medium volatility is going to be more than enough to hit your goals. And so for that reason, what we typically look at when we're working with our fast track clients is setting a really solid foundation with these very low volatility pools. We know that the assets like Bitcoin and Ethereum are the lowest volatility assets in the entire crypto space. And for that reason, we typically want you to be able to allocate the foundational portion of your portfolio into those types of pools. They are low volatility, consistent, solid volume over time, and consistent and solid volume over time typically equals very consistent yield and fees over time for you as a liquidity provider. And so what we typically look at is maybe getting something like 60 to 70% of your entire portfolio into one or two of these low volatility pools. Again, what you're looking at in trying to get into these pools, the ranges are going to slightly differ, whether it's Bitcoin or Ethereum or Solana. But typically speaking, what we're trying to be able to target is maybe something between 6 to 9% in terms of monthly yield by providing concentrated liquidity at strategic ranges for these particular low volatility assets. Again, you can take that a step further by using leverage on protocols like Revert Finance or even DeFi Tuna. We've done plenty of other videos about those on the channel, so make sure to check them out. But getting somewhere between 6 and 9% per month is very possible with these low volatility pools. Again, typically speaking, lower volatility means slightly less yield, but that is the trade-off that you're taking for having a much more safe allocation in terms of your portfolio. Obviously, as we move up the scale here, low to medium volatility and even medium volatility, you're starting to venture into the world of some crypto to crypto asset pairs like WETH Arbitrum, maybe Pendle WETH, maybe you want exposure to something like Ondo WETH or even JLP Solana. And so what you're doing by moving up the volatility curve is you're typically also moving up the risk curve when it comes to the amount of risk that you're taking on by getting exposure to more volatile assets. And so as we move up here, yes, the risk and the volatility increases, but so too does the potential for you to actually earn even better yield. And so when you're looking at low to medium volatility opportunities, you could think about getting maybe, another 20% of your portfolio into those types of opportunities. Yes, you're probably going to have to set slightly wider ranges. And yes, you're probably going to have to manage those a little bit more aggressively. You're going to need to be checking the charts daily. You're going to need to be actively monitoring those positions. But it's definitely possible to be getting somewhere in the region of 9 to 12% per month with those types of opportunities if you manage them accordingly and you're able to essentially stomach the volatility that comes inherent with increasing volatility for those types of assets. And so getting a little bit better yield is what's possible by taking on a little bit more volatility and a little bit more risk. And so, roughly speaking, somewhere in that 9 to 12 per month area in terms of fees from providing liquidity on these types of opportunities is very, very possible. The other biggest variable, remember, in that equation is volume. We need to see consistent volume in these opportunities. And you have to remember that in the crypto space, you're going to get a lot more volume in some of these medium cap tokens when we have periods where altcoins are outperforming. And so I think the next few months will be very good for that. But you also have to recognize as a liquidity provider that there's going to be periods where there's very low volume for some of these particular assets. And therefore, it may not be in your best interest to keep providing liquidity here when you could be getting much safer yield by reverting your capital back into lower volatility asset pools. Again, as we scale up the volatility curve here, again, it's possible to even further increase your yield potential when we get into the medium and high volatility pool opportunities. Again, you're taking on a lot more risk as you come up the curve here, because these assets, some of these are much more speculative, much smaller market cap assets, like Zeus. You've got Cetus token, which is a native DEX token on Sui paired with Sui. You've also got other assets on Sui like Deep paired with Sui. You've got even meme coins like Brett. You've got protocols like Virtuals paired with Arrow. You're venturing into smaller market cap tokens and much more highly volatile tokens as well. And so with that comes even more risk, and you have to anticipate and expect that. And again, increased potential for losses, because ultimately when these assets are very volatile, they can pull back much stronger on a percentage basis as the market fluctuates. And you have to be able to stomach that. You have to be prepared to go with much wider ranges in order to actually be able to account for that volatility. But yes, ultimately it is very possible to be doing even better here in terms of monthly yield. You could be generating or expecting to get somewhere between 12 to 15% per month when providing liquidity to these medium to high volatility asset pairs. And then finally, we do have a degen column in here because, most of this is made up of AI agents as well as meme coins. And yes, you're getting on the degen end of the spectrum when it comes to both volatility and risk. This is highly speculative. And of course, you would not want to be using a very large portion of your portfolio. Many of us have that degen itch inside of us. And so I'm typically okay with members and clients going and allocating very small amounts of capital here. But realistically, you don't want to be doing this with any more than 5% of your portfolio, a very, very small allocation here. Yes, you will get outsized returns. You can definitely be doing somewhere in the region of 15 to 25% per month on the capital deployed here. But you will have extreme levels of volatility. You will have increased potential for losses, and you have to be able to stomach and manage that and use a very, very small portion of your portfolio in order to actually avoid critical losses. So hopefully that's giving you a bit of perspective on what is achievable here in DeFi liquidity provision with different types of assets and different types of risk profiles. Again, thinking about using the majority of your portfolio down in these very low volatility and low to medium volatility pool opportunities. Medium volatility, you could think about deploying, a small amount in here, but realistically, these pools should not make up the foundation of your portfolio. And then using just a very, very tiny percentage to allocate into the more speculative high volatility pools is is okay, but again, you should not be focusing the majority of your attention or the majority of your portfolio over at this end of the spectrum. So hopefully that is useful, guys. Let me know in the comments below which pools on this list are you providing liquidity to. Also, we do have a brand new lead. We do have a brand new guide for you in the description of this video. If you're someone who has more than one Bitcoin and you're looking to capitalize and start increasing cash flow, there is a link in the description specifically for you if you've been holding Bitcoin or similar treasury assets for the past few years and you want to start generating cash flow. Check out the link below. There is a completely free guide for you in the description, so make sure to grab that below. That is it for today's video, guys. Remember, if you got any value out of today's deep dive into that risk and volatility analysis, make sure to smash that thumbs up button below, hit subscribe, hit that bell notification icon, and we'll catch you in the next one.